Affirm shares are skyrocketing today after seeing revenue jump 37% year over year as it narrowed its losses in the first quarter. The buy now, pay later company also saw transactions climb 28% from last year, citing accelerating growth in its debit card. Michael Linford, Affirm CFO, joins us now with more. Michael, thank you for joining us here today. Could you give us an overview of these earnings and stats that we're just throwing out here?
Yeah, look, we're taking share in a growing market. Our revenue grew 37% year on year. Our GMV, as you mentioned, grew 28%, which was 3 times the pace of e-commerce growth in the quarter. And we did that while posting really strong unit economics. Our revenue less transaction costs as a percentage of GMV was at 3.8%, which, for us, we always talk about wanting to be in the 3 to 4% range. And so we're near the high end of our long-term range, despite the macro backdrop that folks have been talking so much about.
And we were just talking with the Traeger Grill CEO in the prior block. He mentioned the desire to buy now, pay later. But overall, consumers are spending a bit less on these expensive discretionary purchases. I'm wondering what trends you're noticing in the buy now, pay later space.
Yeah, we saw really strong results in categories like general merchandise, as well as continued strength in travel and ticketing and experiences. And yes, there's clearly pressure on the consumer in some categories, but that's what makes our product so important. Everything that we do for consumers means more in this kind of an environment. And we're able to do that today. And I think the reason why you're seeing that strong demand on the GMV side is because of the macro environment.
Oh, and your stock is up to a 52-week high today that I was seeing in the charts. Want to talk about credit and delinquencies. We've seen those on the rise. There are some concerns that this could be a predecessor, a prelude to recession. But what are you seeing in the delinquencies here, and what do you think that means going forward for your business?
Our credit results were really strong. Our delinquencies declined 30 basis points year on year. And you're seeing us stand in stark contrast to the credit card banks out there who are seeing continued credit deterioration. We have a structural advantage in how we go about underwriting. We take the world's best machine learning and data science applications and apply them to what we think is a real advantage in transaction level underwriting. And you're seeing the benefit of that really play out right now. We're able to control delinquencies exactly where we want them to be. Our credit outcomes, as I shared on this program many times, are something that we control, and you're seeing us control them right now. And what's really impressive is we're doing that while still growing really quickly. And I think that is a little bit inconsistent with, what a lot of the preconceptions were about us.
I want to zero in on the machine learning that you just mentioned there. I take that to mean artificial intelligence, AI. Correct me if I'm wrong, but how does artificial intelligence, machine learning allow you to operate your business more efficiently? Are you filtering consumers? Are you just optimizing the offers, the interest rate? How does that work?
Yeah, I think the AI moniker has become a bit of a catch-all. We've always talked about the data science and machine learning approaches. And we always stop short of trying to claim that we've got artificial intelligence in our business, because these are really sophisticated models that are highly effective, but they fall short of some sort of artificial general intelligence, which others are certainly working on. We do use the large language models for productivity inside the firm, and we think there's a lot of opportunity, just like any other enterprise, to bring the benefit of some of these really cool innovations to how the enterprise operates. But our underwriting approach hasn't really changed. Our underwriting approach remains one where we consume data from the consumer and the credit bureaus and apply it to the underwriting problem in a way that's predictable, legal, and explainable, which is so important in our industry.
And I want to talk about the macro environment, arguably the most challenging in 40 years. Not a lot of investors around who were experiencing rates and inflation as high as we've seen recently. How do you adapt to this, and what does this mean for your business going forward?
That's a great question. I think this last quarter is really a good example of what we say, what we do means more in this macro environment. We are more valuable to our merchants, to our consumers, and importantly, our capital partners. We are finally getting credit for the credit outcomes that we've been driving in the debt capital markets, and that perception has allowed us to continue to be focused on growing the enterprise. If you think about what we do, we help consumers get the things they want and need without needing to go use revolving credit accounts. And we can do that in a way that controls credit outcomes. And that's why you saw us post the really strong unit economics we did last quarter. The past year has been one where we focused on getting our units in shape. We certainly had to do a lot on the pricing side of the world and feel like we got through that in a way that's really powerful, which sets us up to be very aggressive at continuing to further our mission. We feel like we've earned the right to refocus on continuing to scale the enterprise right now.
All right. Well, congratulations on your quarter, and we look forward to having you back, maybe when delinquencies are actually rising. Michael Linford, Affirm CFO.